Today we're going to analyze the Fort Lauderdale rental market for multifamily properties. And as you can see, we have the MSA drawn for Fort Lauderdale, Florida, which is just north of the Miami metro statistical area. So if we go to our filters, which we like to do to see exactly what it is we're looking at, we are excluding all corporate, all military, all senior, and all vacation, because you will have a lot of vacation along that coastline. We are also only looking at market and market affordable, so we are only looking at conventional apartments. We are eliminating short-term rentals in this data set. So if you ask the question, what about short-term rentals? I'm going to tell you that's not in this data set, so don't ask the question. All right, so let's go and see our location. We can see that we are metro statistical area for market and Fort Lauderdale, Florida, which is pretty obvious by what we've drawn out here. So let's go and take a look at the analytics. All right, so here is our supply snapshot for the Fort Lauderdale metro statistical area. You can see there are 5,849 conventional apartments, and that's from 2 units all the way up to whatever the largest building on a unit value is in that market. I don't study this market very often, so I don't know what that would be. We have 142,063 total units, and there is still 12,108 under construction, and only 787 has absorbed in the last 12 months versus the previous 12 months of 6,839. Our vacancy rate has ticked up from 3.5 to 5.2. So I think this slowing of the absorption is definitely affecting this vacancy rate. And as we can see year over year, we are still showing an increase in market rent per unit. And once again, we are not going to look at the capital market side of this because we are just looking at the space market side. Let's scroll down and see where this is in accordance with our long-term occupancy average. We can see that over the last 22 years, the market likes about 94% occupied. It is currently sitting at 94.79%. So very, very close to that long-term occupancy average. One might argue maybe it's sitting on that line or slightly above it. But we're definitely getting close to that. So let's go look at our data and see what it tells us for all Class A, B, and C combined. And then we'll look at the A's individually, the B's individually, and the C's individually. So here is our combined data set. As usual, we do not look at asking rent. That is what the owner and the manager would like to charge you. Here is what you're actually paying, and that is effective rent if you happen to be a resident. We're going to look at just the 2022 data because the 2023 data is too new. There's not enough information here, so we will not be looking at 2023 at all. All right, so we started the year at 2181. Went up to 2216 and then down to 2202 and up to 2205. So we can see a bit of stabilization here. We'll have to look at our absorption and see why that is. Again, this is across all 3 asset classes, A, B, and C. So let's look over at our deliveries, construction, and absorption. And we can see not many have delivered for the amount of units that are currently under construction. It looks like that since second quarter, first quarter of 2021, they went heavy into new construction and haven't delivered a whole lot. Because in that time frame, it takes anywhere from 18 to 24 months to deliver a property, depending on how the Fort Lauderdale market is for new development or adaptive reuse, because I'm sure a lot of these buildings were churned from office to multifamily, would just be a guess. I don't know. Again, I'm not in this market. But depending on these construction numbers, we can see that not much is delivered. So we had 1345 deliver in the first quarter and only 189 absorb. Okay, then 722 more were delivered. So now we're about 2,250 delivered. And we've only absorbed about 83 of those 2,250 units. Another 376 went vacant, and then an additional 201 went vacant. So now, if we look at the first quarter, second quarter, and third quarter combined with the deliveries, we have more units that have hit the market than are renting. So more and more units are going vacant. Another 992 went vacant, but then we had some absorption. So that explains that slight tick down or tick up in rents by just a little bit. Even though occupancy ticked down, it looks like as those units delivered, they were able to absorb maybe in a brand new building, really attractive, not sure what happened here. But we did get a couple of cent tick up from the 652 units that absorbed, but at least we had some absorption. So about 75% absorbed. I like to see 80% or more for stabilized market, but we're well under what you should be for all these units that have delivered. Okay, so that tells the story of A, B, and C. Let's see if we have one asset class dragging this down and one propping it up. So let's look at the Class A space. So here are the Class A rents for the Fort Lauderdale metro statistical area. Again, we are looking at effective rent. There are 92 total properties totaling 30,482 units. And at the beginning of 2022, first quarter, they were at 2755, went up to 2791, down to 2753, and up to 2760. So again, a little bit of a stabilization here, okay? So let's see what the deliveries tell us as well as the absorption. So delivered 967 in the first quarter, absorbed 280, so only about 25%. That's not too good. Delivered 447, absorbed 316, so some absorption there. 337, then 232, some absorption there, and then 570 and 558. So first couple of quarters, or really first quarter, didn't absorb very well, but then almost kept pace. Second, third, and fourth quarter, which may be why we saw a little bit of tick up, and we even saw a tick up in occupancy. So it went down to 92.3, but then ticked up to 92.4. So that does explain why we had that couple of cent increase per square foot, or a couple of dollar increase, because the per square foot price was the same, couple of dollar increase in the fourth quarter versus the decrease from second quarter to third quarter. And the absorption shows us that. So the demand supply seems to be working, at least in the Class A space. Let's go see what it looks like in the B space. So here's our Class B data. We have 451 properties totaling 46,687 units. We are looking at effective rent. And in the first quarter, we started at 2304, went up to 2345, down to 2327, down to 2321. So it's the first time we've seen two straight quarters of decline, where with the overall and with the A's, it went up, down, up. In this case, we went up, down, down. So steady decline. Let's see what our deliveries and absorption tell us. So we can see there were some Class B units delivered to the marketplace, and we can see where the negative absorption came from. At least some of it came from the Bs. So you delivered 369, only absorbed 110, about a third, but then delivered 275. An additional 206 went vacant. Delivered another 39, an additional 174 went vacant, and then 422 and absorbed almost half, or a little more than half of the 422. So that definitely explains why we have a decrease in occupancy of the Class B space and why we have two straight quarters of decline, albeit not that much, but we are seeing some decline. Absorption definitely is not keeping up with the deliveries, and so we're probably going to see a continued decline in rents, at least until the remaining inventory that's still under construction is absorbed. So let's go see what the Class C space is telling us. So here is our Class C data. There are 4,904 properties totaling 64,264 units. For effective rent, we were at $14.88 first quarter, up to $15.13, up to $15.29, up to $15.39. Now, I have not looked at Class C data, and I'm not looking yet at the vacancy to see if it's ticked up. What I'm hoping here is that we are not seeing what we have seen in a little over half the markets that we have looked at, where the owners are just increasing the rents because they believe they can, and it is not a function of demand and supply. So let's look at this vacancy and see what it tells us. Well, vacancy is increasing. When vacancy is increasing, that tells me that absorption is not keeping up, albeit we still have real small vacancy in the market of only 3.9. So that may be where these owners and managers are thinking, well, we can continue to raise rents because we want to be at that long-term occupancy average. We don't want to be above it, which would make sense, which was, if you remember, around 4.9% vacancy, or 90. Actually, it was like 5.1. I think it was 94.9 if I remember right. In any case, that may be why that could tell a story. I'll give it the benefit of the doubt here, but let's see what the absorption's telling us. So yeah, as I suspected, absorption's going negative every single quarter, which does say that they are tired of these rents. They can't afford them anymore, and it will continue to downtrend until it gets to a price that they like. So the market is definitely saying, stop raising these rents, start declining them, we'll start absorbing again. And once it gets below that long-term occupancy average, these owners will finally get the hint and they will come down on their rents. But it may still take a little bit because the vacancy is still really low at 3.9%. So that is pretty low. So an interesting tale with the Fort Lauderdale metro statistical area. It's not devastating. It's definitely not like the Las Vegas market that we saw last Friday. But it is showing a downtrend. There is a slowing in absorption in the A's. There's some negative absorption happening in the B, albeit some positive in a couple of quarters. And of course, all negative absorption coming into the C's. So we'll see how it performs moving forward. I would place the Fort Lauderdale MSA right on or slightly above the long-term occupancy average in the oversupply phase, transitioning to the recession phase. Just not ready for that transition yet. Still has a little bit of decline to happen. So stay tuned for tomorrow when we are going to be looking at, are you ready for this? The Dallas metro statistical area. And I know that a lot of you have been waiting for this market. So I'm going to go a little above what I normally do, kind of like I did with the Atlanta market. And we are going to benchmark, meaning compare the Dallas metro statistical area, and then we will break out Collin County, which everybody knows is one of the strongest counties in the country, and we'll just look at Collin County at the same time. So prepare for a little bit longer of a video tomorrow, but it ought to be a real fun one, and we'll see what Dallas is telling us. All right, we will see you guys tomorrow.